Joining us to discuss the action is Jessica Hoversen of MF Global. She's standing by at the CME Group in Chicago. Jessica is responsible for statistical and macroeconomic analysis of global markets and also produces daily analysis on interest rates and currency markets. Let's just say she's very smart and works apparently extremely hard. Also with us is Hans Olsen, Chief Investment Officer, JPMorgan Private Wealth Management, which has $120 billion in assets under management. Hans says that unresolved legacy issues from the prior boom-bust period mean that we should avoid investing in riskier assets. If the intros are long enough, we don't have any room for you guys to say anything on the show. Let me start with you, Jessica, and ask you what you make of the Europe situation here, because we've been hearing all day now that Spain may need billions and billions to bail its banks out, and we just talked with an investor about an hour ago who said he thinks they're the next to go. Do you see a wave of defaults coming?
I really believe that we're just at the tip of the iceberg with this whole European crisis. I think that if the subprime crisis taught us anything, is that it starts off slow and then starts to unfold very, very quickly. And it started with Greece. It is now moving to Spain. I think the rest of the peripherals will likely show damaged portfolios. And one of the very interesting correlations that I'm watching right now is that there's a very strong correlation between European banks and the euro. And the more that European banks are sold off, the lower the euro goes. And it could just be chicken before the egg, who's leading who. But I think right now people are very concerned about the European banking sector, because not only do they have underperforming sovereign portfolios, but also if you just thinking about the Spanish banking sector, it has an underperforming real estate portfolio, and that's going to have negative implications just for credit growth and lending and just the general recovery in Europe.
Hey, Jessica, it's Julie here. But what about the interconnectedness of Europe versus the rest of the world? I mean, you compare it with the credit crisis here in the U.S., and it turned out that subprime obviously had its tendrils everywhere. But can you make the same argument for Europe? It seems as though a lot of folks have sort of thrown out the idea of contagion spreading over here to the same degree.
I think that's a very interesting question, and everyone is talking about whether or not the world will be able to decouple from the European crisis. Now, if you look at the exports from Germany to the U.S., it's only about $11 billion year-to-date in 2010, so no, the contagion effect from exports may not be that dramatic. However, if we think of the contagion effect simply from investors scrutinizing European fiscal deficits and investors scrutinizing U.S. fiscal deficits, then yes, we could see a wave of contagion hit the U.S., but more from an implication standard than an actually economic contagion.
Hans, I really want to bring you into this discussion, because you do point out, I'm looking at my notes here, that Spain is next for the European credit crisis. How bad is it going to be, and then what's next after Spain?
Well, the Spain problem is a much bigger problem than the Greek problem, in that Spain is a much bigger economy than is Greece, and the Spanish banking sector is much bigger as well. I agree with Jessica. The issues of the banking sector in Europe are particularly acute, because the banking sector in Europe is about 3 to 4 times larger than that of the United States. So it's relative to the size of the economy. You need a healthy banking sector in order to have a healthy European sector.
It's a bigger deal.
It's a bigger deal. And Spain is in the uniquely difficult position of having these cajas, which are these local, I'm sure I just mangled the pronunciation.
It's like a German Sparkasse.
There you go. Pause with that one. But they're in the uniquely difficult position of these things are in uniquely difficult shape. There are a lot of them, a big piece of the economy, and that's going to need to be worked out.
Is it going to be harder, by the way? In the situation with Greece, we could give them enough money to kick the can down the road. I hate to say that, but that's why they don't have to restructure yet, right?
The can's pretty dented.
It could be a big can in Spain, right?
Yeah.
Is there some point where they just say, look, we've got to go to the banks and restructure this debt. They're going to have to take a haircut. That's the only solution.
Yeah, and what they're doing is sort of the first step to that, right? They're consolidating them. This is what Spain did a couple of weeks ago. They consolidated a series of these all at once, sort of by fiat. And I think this is the first step down that road to try to shore up that sector.
Now, Hans, it's Dominic here. A quick question. We've talked to a lot of traders and money managers out there who are saying that this market is perhaps not trading so much on fundamentals as it is headline risk. Now, the argument there being, is there any way that the fundamentals can even take hold if we keep on seeing headline risk coming out of places like, Europe, for instance, or even Korea?
About 30 days. I'd give it 30 days, and you'll start to, once we hit the new earnings season, that'll take forefront again. Remember, we talked about this the last time I was here. We were at the end of the earnings season. One of the things that I said is, look, we're going to trade headlines now. This is what, 3-4 weeks ago, and that's exactly what's happening. We've been trading headlines. There's essentially 3 risks that the market's focusing on right now. The first is economic, right? That's the jobs data or the lack of jobs coming through. The second would be the sovereign risk, and the third are policy risks, which will be coming down the road. And that any one of those in and of themselves would cause a spike in market volatility. All 3 of them together, which is what we have, guarantees it.
Not a great backdrop for stocks then.
Tough backdrop for stocks, but you look underneath on an earnings front, and actually things look pretty good. And now you start applying multiples, to these $80 earnings on the low end, and you've got a market that could be 14% higher from where it is right now.
Could be.
Could be. Yeah, and so you get into Q2 profits, and if they look reasonably good, which one would expect, then that'll provide some cover for at least equity prices to stabilize, maybe even move higher from here. We're still thinking that, end of year, we're likely to see, high single-digit positive numbers, returns in equities, but we're going to have a very, bumpy ride along the way, which is exactly what we're getting.
Hey, Hub, what do you think about, Dominic had an interesting question, headline risk versus fundamentals, and you were talking about the direct and the indirect hit that we could take from the European crisis. If you just peel that away and look at the fundamentals in the U.S., are you optimistic?
I think that the fundamentals are improving outside of the jobs data, but one of the very bullish indicators that I saw today was that the small business index actually increased. And for the first time since September of 2008, we actually did see an increase in the sub-index for labor in that metric. So that was very encouraging. However, I think sometimes uncertainty can be a self-fulfilling prophecy. And as Hans mentioned, there are 3 very acute uncertainties: policy, economic risk, and also sovereign debt. And if investors have no idea what will actually come of those 3 risks, it's going to be very difficult for them to encourage them to actually step into equities. And if you look at mutual fund flow into equities, it's been quite low, despite the fact that we've had an absolute massive rally since March of 2009.
Hans, let me ask you a question, because Jessica points out that one of the things we're going to see as far as a contagion factor from Europe to the U.S. is more scrutiny when you look at fiscal budget deficits. And Carol has been pounding away for a long time about the fact that the state of the states in this country is really not that great. Are you more optimistic?
Awful, actually.
Well, I see in your notes you say why California is not insolvent. Okay, insolvent may be going a little far, but they have their issues, don't they?
They sure do. They sure do. And they're going to be forced to reckon with those issues, right? Because the transfer payments and the bailout package aren't really coming again, right? That's done. So as far as sort of the big check to get out of jail, so to speak, that's not coming. So that's going to have to be reckoned with either higher taxes or lower spending. And you're seeing it play out across the country.
No restructure there, though.
That's a tough restructure, yeah.
Well, what about, the Bernanke comments today in the interview he did last night, or the event he was at? And he talked about the rate increases. You can't wait until there's full employment. So could we start to see rate increases even sooner rather than later? And is that going to be problematic?
Well, the comment was, we'll have rate increases before there's full employment. I'm waiting for full employment. That's not coming anytime soon.
Right.
And I think he actually even said
400,000 jobs a month for like 3 years before we can make up the jobs we lost.
And what did we produce last month? 40,000 private sector jobs?
Right.
Not enough.
Right.
Sure. I mean, interest rates will go up well ahead of full employment. That shouldn't be surprising.
Can we handle it?
I think we probably can. It's not going to happen anytime soon. It's probably a next year event at best. But Jessica said something that I just wanted to dovetail on. Those National Federation of Independent Business numbers today, very good, right? It was an uptick, but not good enough, right? Normally, those optimism numbers are trundling along at about 99. It's 92.6 right now. That's suggestive of of a 2-tier type of recovery where you have big companies doing extremely well. You see it in the earnings, all good. Small companies, they're still not there.
And we care about them because, I mean,
that's where all the jobs are.
Right, exactly.
Job creation is.
I think it's an uptake, by the way, after like 19 months of bad data.
Yeah.
So it doesn't make you feel so great, does it?
It's hard to put on the party hat. Yeah.
All right, thanks so much for joining us. Hans Olsen from JPMorgan Private Wealth Management, Jessica Hoversen from MF Global. Always a pleasure.